Hey everyone, this is Robert Keens with goldsilverpros.com. I have a very special guest today, Lior Gantz of Wealth Research Group, and we're going to get his take on gold and silver and the markets as well. He has a very special report for you guys out on his website at /gold playbook. That's Wealth Research Group /gold playbook. Lior, how are you doing today?
Hey, I'm doing well, and thanks for having me again.
Yeah, absolutely great to have you on the program, and thank you for joining previously as well on our program. Wanted to have you back on because I think you have some very unique takes on the markets and gold specifically. I know that you have written a piece recently on what you call the last puke for gold. Maybe you can walk us through what your thoughts are on where we are in gold and where we may be going.
Okay, so the last puke is sort of a thesis that after 52-week highs, and specifically after all-time highs, historically, if you look at big all-time highs with a lot of psychological meaning behind them, like surpassing $2,000 US dollars an ounce on August 5th, which was just 2 months before this interview, normally there's either a 10 to 15% correction in the price of gold, obviously a little bit more with the price of silver, and that's what we're seeing. So the idea of the last puke is once this is over, once the traders and whoever else was just looking for the Corona bounce from March until now and is basically out, specifically on this, especially on silver because the gains were tremendous. The next time it goes above 2,000, it's because long-term investors are buying this dip and not traders. So once it peaks, or once it surpasses the 2,000 again, 2,000 an ounce again, that now becomes a very tough support line to pierce through to the downside. And so I think for many people, look, there's always a psychological barrier with saying, hey, I've known about gold for 4 or 5 or 6 years. I could have bought it at 1,000 or 1,100. And so people just don't want to buy, and they eternally wait for that Jeff Gondluck moment, or that, you know what I mean, that 80% drop moment that they think is coming, and it never comes, and then they're in cash. So I don't like that personally, and I wrote a lot about that at wealthresearchgroup.com/bear. It's basically 11 strategies on how to handle bear markets or corrections, because you don't have to commit all the way. You can buy half or a third or a quarter or a fifth of what you intend to buy if you think you're overpaying and that there's a chance of a bigger correction. If you're wrong, then you caught a little bit of the upside here. And if you're right, you still have so much more ammo if you want to make other purchases. And I think that's what it boils down to. And that's why I think it's a last puke. Specifically for silver, Robert, it's still within that 20 to 26 range. So it traded in a very nice range for years between 14 and 20. That created a band that's $6 long. And once it breached the 20 upwards, it flipped basically. And now it had a range up until 26, and it even shot above that. So I was not surprised when it saw so much resistance towards the $30. I just think too many people don't believe that silver deserves to be there, and therefore it's down. But if inflation fears continue to pick up just a little bit in the United States, especially after the elections, when there's a lot of certainty and the consumer will come back stronger, no matter who wins, but obviously, especially if pro-growth wins, then you have a chance here of seeing something that's unique with silver. Because here's my very average take on this, like a bird's eye view take on this. If you leave the house and you just want to grab a few ounces of silver with your bullion dealer, and you have saved $300 or $400, I'm not talking about big investors with 50 or 100K. I'm talking about the average person. And he goes to the bullion dealer, and the bullion dealer tells him it's $30 per ounce, so you can get 10 ounces, or it's $40 per ounce, and you can get 7 ounces, or it's 50, and you can get 6. it doesn't matter to him. He's made the choice to buy it. And so I think with silver, many people, they don't believe it can go to 50 because it's an industrialized metal, and all of these industrialized buyers want to buy it as cheap as possible to put it into their products. But the amount of silver that goes into a product is so minimal to most products, so minimal that if it's 30 or 50, it's not a make or break for these industrial companies. They can offset that with other things, and obviously they can raise prices a little bit because you're talking about marginal price increases for the thousands of uses that silver has. And for the average person, I don't think he cares if he's going to buy 6 or 7 ounces, if he's already out of the house, afraid of inflation, and thinks that something type 2008 or you know what I mean is coming. So that's why I really like silver after this smack here in September.
Okay, yeah, I agree with you. There has been a pullback, and something we talked about with our viewers as well. Not especially popular with the gold and silver crowd right now, but this is normal for markets. And I do believe sometime next year we'll probably get into the gold and silver correction. Want to move over to rates right now and talking about debt and interest rates. What is your view on that topic?
So I don't know if you know this, but in terms of the commitment of traders, there's never been a time where traders have been so certain that the rates are going to go higher. So the amount of global sentiment that bets that the next thing that will happen here is that rates will go higher a little bit is enormous. So you can think what I'm thinking. I literally, I'm a contrarian in terms of if the commitment of traders is the highest of all times for higher rates, I don't like that bet. So because the commitment of traders is retail, it's not institutional, it's not smart money, etc. So that's one thing. I think interest rates are actually going lower, and they can actually go a lot lower. And I equate this period to 2 other periods in history, and that's my case. The one period is a period that happened about 120, 130 years ago when you saw, there's a famous story about Oxford University being the mecca of intelligence around the 1890s, and obviously London being the richest city in the world back then. And they asked those scholars to seal in an envelope, Robert, their 100-year prediction for the city of London. This is 1890. And they're writing, enthusiastically that it's going to be unbearable to live. The amount of horse shit in the streets will pile, and there will be so many diseases, and it will be inhabitable, etc. Little did they know that 10 years later, a schoolboy that hasn't finished the 6th grade will come up with a way to create the Model T. And the horse is going to be obsolete. And then a half-deaf person with a 3rd grade education will find a way to condense light in a bulb, and everything will be electrified. And then 2 brothers out of North Carolina will find a way to get everyone up in the air and invent the airplane. So I think we're in a similar period. There's so much innovation right now. It's just insane. If you think about your life 20 years ago, 10 years ago, 5 years ago, and I think that trend is continuing. When that happened, during the 1890s until the Great Depression, so basically in that 40-year period, interest rates were very low on real terms, very low, negative, because of the amount of innovation. We had just a compression of prices going down in real terms because there was so much innovation. And you can think of, your phone, this call, or anything else that you do, and you have to think how much different your life is every single year in terms of like your options and the things that can happen. So that creates backwardation, or what we call a reversal of the interest rate environment, where the short term is upward, in reverse to the long term, and rates are very low. Then you have World War II, and that era is very similar to what we're seeing right now. Because if you think about World War II, what happened back then? You had the 30s that were awful. And that is very much similar to what we saw between 2008 and 2020. Then you had COVID, which is like the ultimate reset. People are saying, where's the reset? Where's the reset? The reset happened. It was 16 days. The whole system literally shut down. So if the Fed hadn't intervened, we would have had a new system. And they chose not to. So that to me was the reason. Don't wait for another 80% dropper. It's not coming. We're in a recovery. You can call it an L shape, a V shape, a W. We're already in a recovery. And you're seeing tremendous amount of growth everywhere. Think about this. This was the first huge global sized depression that we had. Everywhere in the world, it happened at the same time, and everywhere in the world they're stimulating. So I know this is a very contrarian view, and I know that many people are saying it's impossible. We have too much debt. We have too much bad stuff. It can't be that. Is that it? Was that 16-day 35% drop where $30 trillion worth of stocks and bonds went to was that the reset? Well, it was as close to it as you might get in the next 10 years. So with everything that's going on, I am telling you the time to be more bullish than bearish is right now. And in the 1940s, real rates during that time, right before the dollar standard began. So 1942 until 1947, real rates were -3%. So can they go lower? They sure can. There's a lot of reasoning behind it, a lot of history behind it, and the sentiment is absolutely the other way. All the traders think the other way. So that's really important. And you know what? In March, in late May, so early June, in the summer, and right before this correction, we came up with wealthresearchgroup.com/list/list2, list3, and /tech. All four of them were watch lists that told you, hey, be bullish. Here are limit orders, proposed limit orders. And man, everything that hit that limit order is up substantially. And I just think that was the best choice to make, to be a contrarian and buy.
Mm-hmm. And I know we were talking before we started the video about the millennials, and then I think the millennials may be the most understood group or class of people out there right now. I did a video recently for an O&M presentation on marketing millennials because I think they're the next frontier. I think they're clearly they're rising. Their purchasing power is going to increase over time. They're very well educated, very savvy, and they have all of this innovation, like you said, behind them. What is your view on the millennials moving forward, and how much power will they have in this economy?
Yeah, I think this is where my research is very different than other people's. So if you have an open mind, I think 60% of America's wealth is tied to the baby boomers, and only 3% is tied with the millennials. Now, every 10 seconds as we're doing this interview, a baby boomer is celebrating his 65th birthday, and a millennial, on the other hand, is moving up the corporate ladder, inheriting a great paying job, and thinking about leaving the house, getting married, forming a family, originating a mortgage, all sorts of things that they haven't done. In terms of demographics, you're talking about 80 million people, so a quarter of the country, and they only have 3% of the wealth right now, and their parents, 65 and above, have 60% of the wealth. No reason to make big purchases, so they're not gonna upgrade their homes, they're not gonna buy new cars. They're downsizing, they're living their golden years in general. Think of the amount of wealth that's gonna move in this direction. And you're gonna realize that the millennials are where the opportunities are. And you can already think about the big companies in today's world, and you can see that they're appealing to the millennials. The biggest companies, Amazon, Netflix, Facebook, these are companies that don't target baby boomers. They target young people. Why? Because the life of the customer is much longer. You have decades where you can extract purchasing power from that generation. And millennials are not a US phenomenon. In China, the middle class is, it's a national mission to get the middle class from 10K a year in income to 15K, a 50% increase. Now, I know that it sounds like nothing, but you're talking about over 190 million people. So that's 2.5 times the millennials in the United States. The underlying theme here is that people underestimate the power and the velocity of money that comes with the millennials. And now they've shown you that they're actually like equities. They're getting into the stock market in droves. And I don't think that's changing. The mania that surrounds some companies that have gone to the stratosphere, that will stop. They will get hurt there, they will get burned, but they're not going away. They've entered the stock market, they will go into real estate. There is nothing fundamentally different between them and other previous generations. Human beings are human beings. They want to rise up the corporate ladder. They perhaps have different amount of children that they want to have, different preferences and whatnot. That's for sure. They came up in a world of the internet, of smartphones, et cetera. I mean, the differences are huge between the way the baby boomers grew up post World War II and what millennials are going through now. But at the end of the day, you will not have a country in 10 years where half of the millennials still live with their parents in their 40s. That's not realistic to bet on, no matter what you think about the millennials. It's very similar to what people think about many things that are 30 and 40 years old. So for example, if I ask a lot of people, just in general, what's the cheapest country to make toys in? Many people just say China. But there are 48 countries that are cheaper than China to manufacture. 48 countries, that's a quarter of the world's countries, are cheaper than China. China's not cheap anymore to manufacture. They're cheaper than the Western world, but they're not cheap in general. So it's all these things that we have stored in our heads that are 30 years old. The millennials, 10 years ago, 15 years ago, what they said about them, fine. We live in a new world, and definitely a lot of people have changed their habits in the last 6 months. If you think about it, what will happen in the United States is what happened in the 60s and 70s and 80s. These millennials have gone to college, like the baby boomers went to college in the 70s. In the 80s, they hit their peak earning years, and we saw a 20-year bull market in stocks. Now think about this, between 2008 and 2020, this was like the most hated bull market in history. Literally. Yeah, when you look at the flows, the inflows of capital into the stock market, it's a net outflow from hedge funds, from institutions. Nobody trusted the bull market. Since 2018, hundreds of billions, if not trillions, have exited equities from 2018. If you look at most companies, look at the S&P 500, go company by company, and you will see that in 2018 was the peak for most companies. That was the end of the bull market in terms of not the index, but many of the component companies that are within it. We all know that 5 companies have a 23 or 24% weighting on where this index goes, so it's hitting all-time highs, but 300 or 400 companies out of the index are actually either flat this year or negative. And so there's huge opportunities if you look for specific opportunities and not just generally buy either an index fund or make an assumption about the millennials. Now, I'm not just theorizing on this. I actually have invested a lot of money since March in real estate, and I'm seeing the deals that come through. I'm seeing what top 10 companies like Blackstone, which is the best fund in the world for real estate, what they're doing with real estate, and they're betting on millennials. They're betting on of entire demographics moving out of the city and into buying single-family homes. This is what the smartest people in the world, the people that look at the deals from the parcel, from the land structure, and what they're saying about the purchasing power. Obviously, affordability is amazing. Interest rates are very low. Mortgage rates are very low. And the banks are actually lending. This is not 2009, 10, 11, when you had to have cash and walk to the balcony, the footsteps of your bankruptcy court. This is an economy that's ready to lend. The banks are doing pretty well. They didn't even need a bailout from COVID, and their structure is pretty healthy. Now, again, everything I'm saying goes against a lot of what people hear online, because people have been saying the same things since 2008, and it's just not true anymore. I know it's popular. I know it's very easy to listen to the gloom crowd, but look at results and look at what you really do an accountability with yourself. How have I invested in the last 10 years? Has it got me anywhere? Or do I need to change and be more open-minded to what's happening in today's world? So to me, I'm very bullish on the millennials and what they can do and contribute to GDP in the next 10 years. And obviously, the stock market is expensive, real estate is expensive, asset prices are expensive, but expensive is not a bubble. Having $17 trillion worth of government bonds in negative yielding rates, that's a bubble. And when 10% or 15% or 20% of that goes to equities and to real estate, then real estate and equities might go into a bubble, but certainly bonds are the bubble.
Thank you so much for that, Lior. How can people reach out to you if they want to get additional information on what you're doing at Wealth Research Group?
Yeah, thank you. I think the best way to do it is just to subscribe to the newsletter. The newsletter goes out 3 times a week since early 2016. The reason I launched Wealth Research Group is just because I wanted to have like a platform to share what I'm doing, because my father went bankrupt when I was 13, and I kind of had to figure it out, and I started saving and investing since I was 13. Literally, I started babysitting in the neighborhood. I had like 20K saved up when I was 16, when my bankers told me, you're a minor, get your parents to sign a waiver, and you can start investing. And that was 3 months after the dot-com bubble burst. And in hindsight, very lucky. And since that time, I've been investing and reading a lot of books and whatnot, and obviously running businesses. And I thought, man, this is nice to have an outlet where I can share a lot of what I'm doing. And so that's how Wealth Research Group was founded. It's a free newsletter, and that's the best way to just see where my mind's at and follow.
All right, great to have you on the program again, Lior. Appreciate it. Like to have you again in the future. Thanks for stopping by.
Thank you, sir.